Okay, let's dive right into this. You know, we live in an era that absolutely worships speed and constant motion. Literally everywhere you look, there's a flashing red or green number, a push notification, some breaking news alert, practically screaming for your immediate attention. We've been deeply conditioned to believe that constant financial action is the only real path to success. There's this overwhelming modern bias telling us that if we aren't frantically pressing buttons, if we aren't constantly adjusting and reacting to every little tremor in the market, well, we're somehow falling behind. But when you spend over 30 years immersed in actuarial science and risk assessment like I have, you start to see the world and human behavior very differently. You start to see the hidden math behind all these actions. So in today's explainer, we're going to systematically dismantle that assumption of hyperactivity. We're going to fundamentally reprice our understanding of financial mechanics by deconstructing a singular, profoundly simple piece of source text through the rigorous lens of risk and probability. So here is the big question. Where does true value actually come from? I want you to really, truly think about that for a second. We are so wired for instant gratification these days that we just automatically equate motion with progress. We kind of trick ourselves into thinking value is generated at the exact millisecond a transaction clears. Our brains tell us, hey, if we're moving, if we're doing something, we must be creating value, right? But what if that's just a fundamental misunderstanding of how wealth and reward actually accumulate? See, amateurs typically believe that value is created by perfectly timing the market, jumping in and out to catch the waves. But seasoned risk professionals, we know something else entirely. True value is created by compounding expected value over a long horizon. What if the very actions we frantically take to secure our financial footing are the exact things mathematically destabilizing it? Our source text challenges this deeply held assumption head-on. And that brings us perfectly to the illusion of action. Think about the sheer noise of the market on any given day. It is relentless. It operates at lightning speed, constantly feeding us this narrative that we must always be in motion. Buy this asset, sell that position, pivot your strategy over here, leverage your capital over there. It tricks us into this permanent state of hyperactivity. But from a strict risk assessment standpoint, every single time you yield to that noise, you aren't just moving, you're paying a massive statistical toll. This is what we in the actuarial world call frictional costs and volatility drag. Every spread you cross, every fee you pay, every tax event you trigger by acting, these are tangible, literal leaks in your capital bucket. The psychological treadmill of the market is just a masterclass in misdirection. It convinces us that sheer activity equals productivity, when in reality, mathematical models repeatedly show that this constant frictional drag systematically destroys your long-term expected returns. And this brilliantly illustrates a tug-of-war we see everywhere. It's the desperate urge to buy on one hand and the absolute terrifying panic of selling on the other. It's FOMO, the fear of missing out, giving you that adrenaline rush to jump into a position because you're absolutely sure it's about to take off. And that is perfectly juxtaposed with the visceral fear of losing it all, causing this desperate scramble to exit before things get worse. We are perpetually caught in this exhausting emotional pendulum. We bounce between these two mechanical states, totally convinced that the secret to success is just timing this swing perfectly. But constantly shifting between buying and selling is what actuaries refer to as maximizing your exposure to ruinous outcomes. You are rapidly, aggressively increasing your probability of ruin. Every hasty entry and panicked exit introduces massive variance into your financial trajectory. It creates this constant agitation that totally blinds us to the real, stabilizing truth of the source material we're looking at today. Because here's the profound pivot in our text. The secret is not in the buying or selling. I just want to stop right there and really let that sink in. The very mechanics we spend literally all of our time obsessing over, the frenetic actions that generate all those transaction fees, all the bold headlines, all the late-night anxiety, they are emphatically not where the actual profound results are found. The text just pulls the rug right out from under the entire concept of constant trading. Look, from a strict risk modeling perspective, buying and selling are merely moments of acute vulnerability. They are the solitary moments where you crystallize risk. When you execute a trade, you are temporarily exposing your hard-earned capital to the immediate, chaotic variance of the open market. The text takes our deeply ingrained binary framework of buy or sell and completely, utterly dismisses it as the primary driver of success. Which leads us to the full, unvarnished truth of our source text. The big money is not in the buying or selling, but in the waiting. Notice the incredible contrast here. We were just talking about the frantic, exhausting energy, the frictional drag, the probability of ruin, and then the sentence gracefully resolves with the absolute stillness of the waiting. It is absolutely fascinating to me that you can take decades of building incredibly complex actuarial risk models, running millions, literally millions of Monte Carlo simulations, analyzing vast oceans of data, only to realize that the underlying math points right back to this one strikingly simple sentence. It strips away all the modern algorithmic complexity, all the absolute frenzy, and leaves us with one unavoidable, deeply challenging truth. Now, what's really interesting here is that to truly grasp this, we have to fundamentally redefine the word waiting. In our hyperactive, always-on culture, waiting sounds, well, kind of like a weakness. It sounds incredibly passive. It's like you've simply fallen asleep at the wheel or you just don't know what to do next. But derived directly from the logic of our text and supported by heavy risk theory, waiting is actually an active, deliberate financial strategy. It's a highly calculated risk mitigation tool. When you wait, you are strategically allowing the law of large numbers to take effect. You are allowing time to step in and smooth out the daily chaotic variance of the market into a predictable upward-sloping trend line. Actually, think about it. It takes way more mental fortitude to watch the noise, to feel that burning urge to buy or the terrifying panic to sell, and consciously choose to hold your ground. True waiting isn't an absence of action. It is the ultimate, most difficult mastery of it. The waiting. Let me give you a surprising mathematical reality that illustrates exactly why this quiet space is so absolutely critical. If you look at historical data for the S&P 500 over a typical 20-year period, there are over 5,000 trading days. Now, if you just leave your capital alone, if you simply wait, you capture the full annualized return. But if you try to constantly buy and sell and you happen to miss just the 10 single best performing days out of those 5,000, your long-term returns are essentially cut in half. Let that sit with you. Missing just 10 out of 5,000 days destroys your wealth. The statistical anomalies that generate true exponential growth happen in brief, totally unpredictable flashes. Mathematically speaking, waiting is the only guaranteed way to ensure your capital is present to capture those anomalies. It is entirely in this quiet space, totally free from the destruction of constant transactions, that true growth actually takes place. So let's see how this builds, because when we map this progression out, a really clear evolution appears. We start at the top with the noise of action, that external, chaotic pressure demanding our immediate attention, throwing all these high-variance emotional triggers at us. Then we often get trapped in that middle layer, the mechanics of buying and selling. That's the physical manifestation of yielding to the noise, where we maximize our frictional costs and, as we talked about, our exposure to ruin. But the ultimate evolution, the highest level of operation according to our source, is breaking through all of that to achieve the discipline of waiting. We move from high-variance, emotional trading to low-variance, high-probability compounding. This single sentence brilliantly moves us from the anxiety of pure mechanics right into the quiet, unshakable power of mathematical discipline. It really is a total paradigm shift for anyone willing to actually internalize it. So the crucial point is this. The text rightfully begins with the big money, the ultimate reward, the true wealth generation. It doesn't deny for a second that the goal is substantial and highly desirable, but it explicitly and firmly maps the only mathematically sound route to get to that goal. It completely bypasses the toll booths of constant trading, it ignores the sirens of market variance, and it directs us straight to the discipline of patience. The big wait isn't just passive hope, guys. It is an aggressive, mathematically sound risk strategy. You are actively letting time absorb the risk so that your capital can capture the reward. The reality is, you simply cannot have the big money without mastering the big wait. Which leaves us with this final, vital question for you to take away from this explainer today. Do you have the patience to truly wait? When the market is screaming at you, when the urge to act feels absolutely overwhelming, can you embrace the active, deliberate strategy of stillness? Look, the philosophy laid out in our source text is remarkably clear, and 30 years of actuarial math backs it up entirely. But executing it? Well, that requires confronting our own deepest, most restless habits. I really want you to deeply ponder this as you look at your own risk parameters and your own daily decisions. The profound impact of internalizing this one-sentence philosophy could fundamentally change how you operate from here on out. Thank you so much for joining me to explore this, and I will see you on the next one.